And don't forget to look at the camera. Let's have some fun. Good morning, everyone. Michael Carlin, president of InterOcean Capital. Wanted to say a hearty welcome to 2023 as we are launching our 2023 Capital Markets Outlook. We a little bit of window dressing for those of you that are new to this recording. I've done these recordings every quarter in some form or variety going back to 2007. So been doing this for quite some time, and the whole premise behind the Capital Market Outlook, and for those of you that are regular listeners, you already know this, but it is for us to take a breath, to take a quick look at what the economy is doing, what the stock market's doing, look at all of the relevant and unbiased data points that exist. We're looking at that every day. We're aggregating the best data points on a continual basis so that we're constantly evaluating where we are now, where we've been, where we're going, and get a historical context so that we can make the best decisions for our client portfolios. And we use this format on a quarterly basis for us to discuss those things in a way that hopefully you find fun, entertaining, enjoyable, because we know, excuse me, we know that everyone's inundated with market data, whether it comes from your favorite business news station that you're watching in the morning, or publications or internet websites or whatever it might be. We seek to cut through that noise on this podcast every quarter. And part of what makes this podcast super special is we are joined by Bhavna Kirana, and Bhavna is a partner at InterOcean, CFA, an accountant. She's a genius with 17 years of track record. I'm happy to call Bhavna my partner, and as you all know, or most of you know, we were fortunate enough to join forces with InterOcean Capital it's starting in June of 2022 last year. So this is our first launch, Bhavna. So I'm so excited that you're here. Thanks for joining.
Thank you so much for inviting me and being a part of this, Michael. I know you've been doing this for such a long time, so I'm super excited. We'll have fun in the next 1 hour. I just wanted to say, everyone, a very happy new year, and let's get started.
All right, let's get started. I thought for a second you were going to call me old, and I was like, oh no, like I know I've been doing this a long time, but please, you know, I hear enough of that from my kids, how old I am. Okay. So let's go ahead. We've got a lot of data here. Oh, another note is that we've updated the format a bit, and what we are trying to do now is we've condensed the format into 10 of the most pertinent areas that we need to be covering. We did end up sending that in your invitation, so you might have seen these 10 topics we'll be going through. You know me, and you'll get to know Bhavna. We're going to take you through the world of data. There's going to be a lot of things that we're interjecting throughout. So I hope you enjoy the new format. Let us know if you've got questions. There's a Q&A button, or a chat button that you can use on the bottom of your screen. If it's a cell phone, good luck finding it. But hit the chat button. Brett is watching, and he's ready to forward the questions along to Bhavna and I, and then we'll do our best to answer all of them. Let's go ahead and launch. Okay. Here we go.
We did talk about how last year was for us as a firm, but I think a great start for today's discussion would be probably talking about how last year was for the markets.
Yeah, I agree. And that's exactly where we're going to start with the recap of 2022. So let's go ahead and do that. Wow. So how the year was for us, I think we had a really successful year, and obviously it depends upon which portfolio you ended up having with us as a client. Some of the more conservative clients, or some of the more tactical clients, some of the clients that use the hedge portfolios and things like that we use. Your results may vary, but for us, largely it was a really successful year to reduce client risk, because wow, what a difficult year it was. When we're looking at so many parts of the stock market here in blue for the year, we're down about 20%. And that's after having a really huge rally in the fourth quarter of 2022. So the market rallied strongly. So you probably saw some improved performance those last 3 months of the year. But that doesn't supplant the fact that the market largely struggled. And it wasn't just stocks. Bonds here in yellow, you can look for the whole kind of year-to-date numbers. Bonds struggled as well. So we kind of look at this intermediate, US bond as that ultimate benchmark, but down 13% for the year, 2 consecutive years of negative performance for bonds. It's statistically significant because those 2 negative years wiped away 5 years of bond performance. It was a really difficult time for bonds, obviously. So we get that and appreciate it, which is part of the reason why even like that stock to bond 60-40 portfolio had one of its worst years in a really long time in 2022. There were some areas of positive surprise in midstream energy being the #1 performer. I'm happy that midstream energy for many of our clients, certainly based out of the Arizona office, it was one of our largest holdings across the board. So you may have seen that holding in your portfolio. We're happy that it was there. And we're happy we were able to avoid some other parts of the market that didn't perform as well. You'll find that normally our bonds across the entire firm of InterOcean, we tend to stay short-term, high quality, and those are the bonds that perform best. Not featured on here, the worst performing area of because it's not technically the market, would be Bitcoin, and the whole cryptocurrency area got annihilated down about 70%, which is interesting because the best performing area of the market year to date, cryptocurrency. What a difference a year makes. So we're seeing, look at here, a year to date, this is through, by the way, Monday of this week. We're seeing a nice positive rebound. And when we look within that rebound and how things are performing better, of course, we're delighted that our client portfolios on balance are doing well, with both stocks here in blue and bonds here in yellow performing well. That's great. But there's a lot of there's a lot of other data that we need to get through because we're not taking a huge amount of relief to say, okay, I guess the worst is over, all systems go. There's a lot of other things that we're going to get through. So again, we've seen a nice positive bounce. It's typically the areas of the market that have performed the worst are performing the best so far this year. We'll do our best to cover more detail on that. And just a couple of other quick points is that 2022 from a historical context, when you look at how stocks and bonds performed poorly, I think this is a way to illustrate just how rare this poor performance was for both stocks and bonds. You look at, years going back to the 70s, this is such an outlier year in terms of negative stock and bond performance. It's not necessarily a huge surprise. We're seeing a rebound so far this year. And one of the other things that I wanted to cover, because for those of you that are regular listeners, you know that I've talked a lot about negative yielding bonds, particularly those overseas. And it wasn't that long ago that we were looking at $16-17 trillion of negative yielding investments. And for those of you that are new to the concept or just this whole thing of negative yield, what does it mean? There was a whole collection of government bonds overseas where you as an investor or any investor or institution buying those bonds overseas, if you bought a negative yielding bond, it would mean you give them $1 million and they're going to guaranteed give you a negative rate of return over the life of that bond. It seems absurd, but we were living in a world where we had $17 trillion of those kind of bonds worldwide. Look at the difference of 2022. We went from, as interest rates were rising, the number of negative yielding bonds have effectively come to just about zero today. And the reason why that's important is because there is certain kind of financial engineering that occurs and you get like unintended consequences, kind of like a butterfly effect. When you have those negative yielding investments, it's going to have an impact on the stock and bond market. And now with that gone, there's an interesting element that's missing that we're going to have to see how that's going to impact the stock market without these negative yielding securities. So we'll talk more about that over time. But with that, Bhavna, one of the issues that we really need to wrap our arms around is inflation. And, inflation in a lot of ways, depending, because it has such a intrinsic part of what the Fed is going to be doing, is a huge story for 2023. So we really need to wrap our arms around inflation. So take us through what you see. and take us through what you're thinking.
Absolutely. And before we jump into that, I actually do want us to go back a few slides, go back
Sure.
to the chart for 2023. And when you look at those numbers, again, to your point, what a difference a new year makes, it kind of almost makes you feel like just because we've had a start of a new calendar year, we wish we got to reset on all the issues that were going on last year.
Right.
But as we will discuss through the rest of the presentation here, that unfortunately is never the case. And a lot of those issues that were very, very prominent last year for the economy and the market are just continuing to be the same topics of discussion for us, including inflation, which you had talked about inflation in a lot of detail in your last quarterly commentary. And again, it still is a very prominent issue. Just skip to the next slide for a real quick. And then the only comment I wanted to make on this anomaly of a year is, it kind of makes you think back that for every unusual year like a 2021 in the market, there will always be another unusual year like 2022. And then it just kind of makes us put things into perspective, saying if we just zoom out a little bit and look at 21 and 22 together, a lot of things make sense because 2021 was all about pulling forward the demand, the growth, all the great things that were happening. And 2022 was just kind of giving back a lot of that momentum. So just changing the timeline and zooming out sometimes puts a lot of things into perspective. But to your point, it was quite an unusual year, and hopefully we won't see that repeating in this year. With that, let's move on to our next topic of talking about inflation. Like I said, I know you talked about this in a lot of detail in your last quarterly. And obviously, this has been a topic of very widely covered by the press as well. All the financial press and the news media have been focusing a lot of attention on the 12-month rolling numbers, the year-on-year CPI prints. And again, we talked in a lot of details about how, very intentionally, the CPI calculations have a lot of smoothing out effect in it, so that the curves don't look very dramatic both on the upside and on the downside. But making those changes to the way the CPI is calculated also has its own side effects in an environment as extreme as this. Because, for instance, if you start reading through these numbers literally, especially the shelter component in the CPI, it's almost making you, believe that the housing prices are still rising, which we know is not really the case anymore. But it's the lag effect in the numbers. And we know that, the housing prices almost have a 12 to 18 month lag into how it reflects eventually into the CPI numbers. So our perspective on this is that we probably need to, again, step away from the 12-month rolling numbers. And again, if we move to the next slide here and actually look at the month-on-month annualized prints for CPI, we think that it actually gives us a much better read into what's really going on with inflation. And we can actually make a more clearer observation that inflation has peaked, in the last, around mid last year. And since then, we've definitely seen it kind of cooling off. Does the Fed still believe that? And again, that's an interesting aspect because, again, within a span of 2 years, 2021, the only thing the Fed had to say about inflation was, oh, don't worry about it. It's all transitory. We'll all be fine. We're just going through this phase and everything will just self-correct itself. To 2022, wherein they had to just do a complete 180 degree on that statement, saying, maybe it's not transitory, maybe it's more structural in nature. And we kind of we're kind of sitting somewhere in the middle of those two spectrums, saying, what if it's a little bit of both? And probably the Fed also needs to kind of lean towards that thinking, saying, we are seeing some considerable slowdown in the CPI numbers. There is obviously a lot of lag effect in the data. And therefore, we do have to slice and dice the data from a slightly different perspective so that we can actually get better understanding of what it's trying to tell us of what's ahead. So again, very interesting on what the media has been focusing on versus what we hope that the Fed would focus on when it makes a lot of important decisions as we progress through this year.
Yeah, because it seems to me, Bhavna, that, well, again, and this is the way the market always works, is that the market is extremely reactive to the way they see all the new inflation numbers as they come out and economic numbers as they come out, because they are highly reactive because they think that the Fed's going to do a certain thing. And it seems like right now the market's expectation is, well, geez, inflation is going to end up being, inflation is going to be tame towards the end of the year, and then the Fed's going to be able to cut. So there's really nothing to worry about. That's a bold,
Right. And
that's a
again,
bold suggestion.
Yeah. And again, so far, based on what we've been hearing from the Fed, recently, they do tend to have a slightly clear opinion on, for different reasons, that inflation is not, we're not going to hit our 2% inflation target anytime soon. We're on that trajectory, but it's probably not happening this year, which again, to your point, leads to other important decisions, including how much interest rates need to go up, how much more work do they need to do to engineer a slowdown in the economy so that we can actually bring inflation under complete control and don't end up in a situation like the 70s and 80s ever again. So again, we'll talk about a lot of that in a lot of detail, but all of these things are just so interrelated to each other.
So we did get a great question about whether or not this is going to lead to a recession. We're going to do our best to answer that question. I think that's a great question, because that's essentially all of this data is going to build the case towards that ultimate analysis, which we've got towards the end. So it's a cliffhanger. Tune in, stay tuned. Bhavna, global inflation, anything to draw?
Yeah, and again, this next slide kind of points out that inflation is, fortunately, unfortunately, is not just something that the US as an economy, as a country is facing. It is a very global phenomena, thanks to the pandemic, wherein it just kind of led to, what's been now known as supply inflation. There were just so many bottlenecks through the supply chain that it just led to across the board, across all different nations, higher inflation numbers, including Japan, which for decades has been battling with deflationary environment. And then the Russia-Ukraine conflict didn't really add, it just added to the wars that were already going on. So a global phenomena, which again, we'll talk about this in future, in certain sections in our presentation later on, but it also kind of highlights on how much of a global coordinated effort it needs to be by the central banks across the globe in trying to control inflation, because again, everyone is experiencing that. And again, other things that they would need to do down the line to make sure that they were all aligned in how they were tackling it, not just as individual economies, but also on a global perspective.
Yeah, and in this chart, the 2022, just you can see the sizzling red inflation numbers virtually across the world, with the exception of China and Korea. It was a problem worldwide.
And again, we've talked a lot about inflation and inflation, what would do to that to the economy. But again, the US consumer is a very, very important aspect of the US economy. So Michael, my question to you was, now that we've talked about inflation, what do you think about the state of the US consumers heading into this new year?
Well, I mean, and for those regular viewers, that we harp on the US consumer, because we know as the US consumer goes, so goes the US economy, because so much of our economy is dependent on US consumer spending. So let's look to see how healthy the US consumer is. One of the things that you'll get some pessimists that will say, geez, they look at the labor force participation rate, which is kind of here in this orangey brown color. And what this is measuring is the amount of folks as a percentage of the US population that are participating in the workforce. And this has consistently been going down and going down and going down. Of course, COVID was a big hiccup, but look at this multi-decade sequential trend of just less folks in the workforce as a percentage of the US population. And I'm at the moment, I'm generally not concerned about that number. I think that there's a lot to yet be explained, that where there's so many other ways that folks are making money, whether it be, I hate to use a term, but the gig economy, Uber driving, those kind of, like, there's some folks that are just kind of not participating on the grid the same way that we're traditionally used to seeing. They're making livings in different fashions. There are some folks that are just straight retiring earlier. We know all of those things, and we know as the baby boomers age that we're going to end up seeing some of those folks retire. We are also seeing, demographically speaking, some of the younger folks not entering the workforce quite as quickly as we are normally seeing. I think that those two trends are coming together, which is also helping to shape this participation rate that isn't what it used to be. But I do look at the unemployment rate, and statistically speaking, and I don't, some of our clients want to get into the dynamics of how they calculate inflation or how they calculate unemployment and how legitimate are these numbers. And listen, the Bureau of Labor Statistics that tracks this information for unemployment does the very best that they can, for sure. And this kind of consistent data, what it's suggestive of is we're really back to and close to kind of this full employment environment, which is a wonderful thing for our US economy, because it means that more folks are employed, more folks have jobs, which they're continuing to spend. I think that that's great. So from an economic standpoint, if we're kind of looking at this, and I've talked about it before, ask what's an asset to the US economy and what's a liability, what's a problem. The unemployment rate being as low as it is I view that as a strong asset. This is something that's very much in our favor, that helps make the case for continued US economic growth, which is great. And by the way, we saw December economic growth numbers came out this morning, the day that we're recording this call, and they seem to be a little bit more positive than some were expecting. So that's great news. Job market's a part of it. The only thing that I view as negative is that when we kind of get to these historically low numbers, it's usually the signal that good times are coming to an end. But that's just me being a glass half empty kind of a person. Go ahead, Bob. Now looks like you're ready to say something.
Of a push and a pull between these two data points, right? The low participation rate is also a factor why the unemployment rate is low. Because again, think about it this way, the pie itself is shrinking.
Yes.
And therefore, we still all through. So on one hand, we're getting almost on an everyday basis news articles on how tech companies and businesses are laying off people. But you turn around and look at the job openings data, and there is an insane number of job openings out there. So for a second, you're like, how are both the things happening at the very same time? It does not add up. Are people just not willing to accept the job that's literally out there? And then, you talk about labor force participation rate, that kind of explains why some of those dynamics are at play. And this also is probably something that's kind of complicating things for the Fed too, because they're obviously paying a lot of close attention to the low participation rate as well, saying, okay, that's really actually making things tighter for us, because if there were more people out there willing to work, and there were these many job openings, they could have a more better control over the job market in general, the wage growth in general. So again, this is adding further complications for the Fed as well.
Sure does. The Fed's got a tough job as it is. That doesn't help. I'll scoot through a couple of these other components because it's important that we cover both. This is another way that we kind of look at inflation, where on a percentage basis, we're seeing that rate, and Bhavna did a wonderful job already going through it, but we're seeing that rate of change with inflation coming down. We are seeing that also in wages as well. So we look at average hourly earnings as a way to kind of measure wages, where you had the certain spike up as the economy was surging. We've got the COVID declines to average hourly earnings. We saw that then subsequently improve. Point is that on an inflation adjusted basis, wages went up, but inflation went up too. And then inflation continued to go. Wages haven't done a great job keeping up with how, especially because inflation's been so hot. So it's interesting to me, but on an inflation adjusted basis, we do see the average hourly earnings folks doing better, but it's a slight bit better. So we know that wages have gone up, but so have the cost of living. On a net basis, when you add it all up, it's you know, on a nominal basis, man, it looks like people are earning a lot more, but then when you account for inflation, it really isn't quite as impressive. So if we're, again, looking at whether or not this is a good or bad thing, this is kind of a neutral as I look at it. What's critically important is that, you know, we're looking at, you know, people's real personal income, not including the government transfer payments, which is, you know, things like COVID payments, COVID relief. We saw the hit with COVID. We've seen a solid rebound. We're almost back to trend. And if we're looking at real disposable income, however, disposable income inclusive of expenses, we see wages rising. We've seen that they've gone up. But again, the real on an after inflation adjusted basis, this is starting to look a little bit negative. So we want to be concerned and cautious about the US consumer. So we're looking at things like, well, if they're earning less, how are they continuing to spend? And one way is through credit cards. And my goodness, you can see COVID hit again, as we've covered this chart before, people were paying down and paying off their credit card balances with COVID relief funds. We saw that reverse, and we're right back on trend with where we had been to that credit card, the amount of credit card balances nationwide, and the rate of change in credit use as it's the quickest and most aggressive change in credit use in recorded history. So the optimist in me says, well, you know, that helps explain why consumers have been strong. If I'm a glass half empty kind of a person, I look and say, well, geez, aren't consumers running out of ammunition? And we do look at things like how much consumers have in cash at the bank, because we know when COVID came, their cash balances quadrupled, and we're starting to see those cash balances come down. So the difficult part from the US consumer in terms of the quality and their overall financial health is they seem to be running out of room with credit cards. We know on an inflation adjusted basis, the wages that look good on paper weren't quite as good accounting for inflation. And it just seems like they're running out of room, and we're seeing the amount of balance, cash balance that they have at the bank is also starting to dwindle as they're spending their COVID money. So how's that that's almost like a glass half empty thing. I know, but that's really the state of the consumer. Listen, we've been better. We're better off last quarter than we are this quarter. It could continue to get extended. We'll have to watch it, but I am worried that the US consumers running out of fuel, Bhavna.
Yeah, true. But it was interesting to see the Q4 GDP print coming out this morning,
Yes.
and it did, at least to your point, we still haven't seen it yet. The US consumer is still humming along. You know, that was still a little bit of a bright spot in that report. But, you know, again, on a glass half full perspective, looking at data, what it's trying to tell us for how long can this go on? You're probably at some point going to run out of fuel, which again would be understandable because of, you know, obviously a lot of things that we just talked about, but also that the Fed is also intentionally trying to bring a slowdown in economic activity across the board.
Yeah.
And a lot of different levers that would be pulled to make that happen will in different ways affect the state of the US consumer going forward.
And there's the Fed's impact on the economy. And then the Fed, as the Fed's doing what it's doing, the stock market's moving. As the stock market's moving, individuals and institutions are looking at the valuations, or, I mean, again, how fairly valued, overvalued, or undervalued stocks are. And it's really important that we understand it, because it's going to help us position client portfolios to be more or less or neutrally aggressive, right? As we're looking to accomplish each individual client's goals. And everyone's goals are different depending upon how much risk we want to assume, what kind of growth we want to get. But understanding whether we're going to over or undervalue stocks, Bhavna, we need to know about equity valuation. So you've got to take us through what you're seeing.
Yeah. Absolutely. And I'll probably at this point address the question a little bit that we received about recession, because again, you know, it's important for us to take a stop and also pay attention to what the media is talking about, what the economists in general are thinking about. And heading into this year, you know, for different reasons, fortunately, unfortunately, a lot of economists are sitting on one side of the boat saying there would be a mild recession this year.
Hopeful.
This year would probably, upcoming recession, if there is one, would definitely be the most talked about ever, because all we've been doing for the last 12 months has been talking about, will there be one?
Yeah.
So that's that. But again, zooming out, putting things into perspective, on a 3-year time frame, let's just think about what has happened with all of us and the market and the economy in the last 3 years. We've intentionally, because of the pandemic, just completely halted the economy to a complete standstill, then overstimulated it back because we wanted to just come back to normal as fast as we could. So there was a lot of fiscal spending, stimulus checks, etc., to just, again, overstimulate everything. And then again, we suddenly started increasing interest rates because we now need to slow things down because it was too fast, too quick. So within a 3-year time frame, we went to a complete full stop. Let's all guns are blazing to, we need to slow down again. So again, we are in that territory wherein there is no rule book here from this point onward. So, which also, when we look at, what we think about equity valuations for this year and how this year might unfold for different asset classes, we have to remember that the probability of outcomes is pretty wide, just because of what a unusual last 3 years we've had and how much we've actually done to the economy by intervening into the regular systems. So with that, generally speaking, let's talk about the next few slides on where we think we are with the equity valuations. And again, last year, broadly speaking, being down for the market, equity markets, 18 to 30%, looking depending on which different benchmarks you are looking at. That has definitely reset the valuation levels to some extent. So it has definitely improved, the multiples, the price multiples for the market, because we've kind of think about it this way, all the activity and the downside movement that we saw in the equity and bond market last year was almost like, a down payment for, there might be a recession on the horizon here. So we've already reacted to that to some extent. And what that's done is, if you look at the chart on the left here, it has definitely brought the forward PE multiples for the S&P 500 a little more to a reasonable level, a more moderate level from where we were a year ago. So that's a positive. But again, when we think about the PE multiples, especially forward PE multiples, there are two aspects to it. The price, where we are right now with the market pricing, and two, the more critical and also a little bit of an unpredictable aspect of it is the earnings capacity of the companies that we are trying to value. And that's a little bit of an unknown. And again, given what we've gone through, it is fair and reasonable to expect that earnings would likely decline as we get through this year. So again, that makes things complicated for us, saying we are talking about PE multiples, but what happens to the earnings, we'll find out soon. And so far, we've kind of had a little bit of a start to the Q4 2022 earnings season. We're obviously seeing a lot of big businesses providing very critical information on how it's not been a good quarter for them. And they're also trying to set expectations for what they think 2023 might be for them as businesses. So again, it would all make reasonable sense to expect corporate earnings to decline from what we'd seen in the last few years. If we look at the right-hand side chart here and kind of try and put this into a historical perspective, again, there are baseline suggestions here that we may see as big as a 20% decline in earnings of corporates. That number we haven't seen it yet, first of all. From this perspective, and at this point, the market is still expecting a year-on-year earnings growth for 2023 now, about 5%. Right. And that may turn out to be way too optimistic for the year, given where we are, given so much that needs to happen and happen right for that to be the outcome. But again, 20% is, again, we haven't seen signs of that yet either. So it would be interesting to see how earnings for the US corporate kind of unfolds this year. And that would obviously determine a lot. But again, we're starting at a much better base here because of the price correction that we saw last year.
Like here in
versus-
yellow, right?
Correct.
Yeah.
Correct. So there's definitely that.
Well, that's good. That's good news. Did you want to get through this one or yeah?
Yeah, no, this is again, a slightly different perspective on looking at the forward PE multiples, but more from a growth versus value investing themes. And again, one very, very clear theme for last year was we saw a pretty dramatic decline in the growth segment of the market. So you can see on the chart this very, very dramatic decline that we saw on that blue line there. But again, zooming out, all of that makes sense. It does things put into perspective as to why we saw such big booms in 2020 and 21, and why, the growth segment of the market was kind of getting ahead of itself, was starting to defy the fundamentals to a great extent. And to that mix, you add the end of an era of 0% interest rates. So the future earnings for a company that's being valued by the earnings that would have down the line, you're applying a much higher discount rate to those earnings to try and come up with a valuation for that specific business. It again makes a lot of sense as to what happened last year and why we saw a lot more dramatic effect in the growth segment of the market versus the value. But what does that mean going forward? We do think that, again, value on a relative basis still looks cheap. And everything that went on in the growth segment of the market, again, we can make sense of that.
Yeah. And that's, yeah. And it's interesting though, but I mean, this kind of follows the age-old adage that, particularly in the market, something that has just been so hot, it's not uncommon for that to go through periods of cooling off. And I encourage those folks, like if you made a lot of money in your FANG stocks, your Facebook, Apple, Netflix, Google, if you made a great return there, just because some of those things are down, doesn't necessarily mean that given the economic circumstances that we have going forward, that it's a shoo-in that they're going to automatically bounce up and go back to the levels that they were in 2020. So we are exercising a high degree of caution and not racing back into those super ultra hot names of 2020. So sorry, go ahead, Bhavna.
Yeah, no, and again, I'm just going to sum up this again. The perspective this chart is trying to look at is, looking at the S&P 500's forward earning yields minus the 10-year US Treasury. And that kind of gives us a sense of, again, is the additional reward and premium that we can expect to get from equities going to be worth the additional risk that comes with it. And our view on that right now is that the time to be exceedingly bearish and worried about the market is probably past because of what the markets did last year. And a lot of that was, again, in anticipation or reaction to what might unfold this year. So a lot of that reaction is already in the books. So again, time to be very exceedingly bearish is probably past, but it's also not, we're also still not at a point where it's a screaming buy opportunity in the market. And that, to your point, our perspective would be still stay a little lower on the risk spectrum, still be cautious. There may be a time in the future wherein we may see a more screaming opportunity out there, but we're not there yet. And again, this chart is kind of trying to put that into perspective for us by comparing the earnings yield, forward earning yields on the S&P versus where we are with the 10-year Treasury yields right now.
Yeah. Well, we're going to talk a little bit about, and it's interesting as we talk about that. I mean, with interest rates being so high on the short side, it's things like Treasury and money market that have been become viable investments for the first time in a really long time. And in my career, I don't know, I've been doing this for, 27, I guess this is my 28th year. And when I started, you could make a reasonable rate of return in bonds there was a real larger pocket of time these past 27, 28 years where that wasn't the case. And here we are now where, things like money market, short-term treasuries make sense. I don't think things like CDs make sense. The banks aren't yet rewarding their customers with really high yields, but it's interesting as we're talking about positioning and valuation. There are some things that we're looking at and that we're utilizing more than we have in certainly a long time. And as we talk about positioning the clients' portfolios, we do look at sectors and say, well, where should we be positioning client assets? Are there values? Are there opportunities for us to be exploring? And what I would show you here in red is, in 2022, there's an awful lot of red. And the red indicates those areas, so certain sectors, parts of the US market, whether they be specific sectors or broad parts of the US market that really suffered last year. There were a couple of notable exceptions. Energy had a huge year last year. We talked a little bit about midstream, which was a plus 30. Broadly speaking, energy, your big oils and drillers and the such, up 65% roughly last year. The defensive part of the US market, of course, when people are running for the exits, performed well last year. What I want to make sure that we're clear on is that, even with a remarkable run that energy had last year, and inclusive of that remarkable run, it has not been the best performing area of the market over the past 10 years. Hasn't even been close from a broad, long-term, big picture perspective. Energy, in fact, had struggled quite a bit. Last year was quite an exception. So we were happy to participate in it, and we're actively looking for values. But I just be cognizant of the fact that chasing that hot dot or chasing the area of the market that had performed the best. If you're looking for a strategy, and don't do this, by the way, and we certainly don't either, but you could almost look at the worst performing area of the market and then just go ahead and look to contribute funds there starting the next calendar year, which, by the way, is part of what we're seeing this year. And as we look, energy and communication services are really the only two sectors, broadly speaking, that are at their 30-year average valuations or better. So we are cautious, and we are aware of certain areas of the market that have performed, those that haven't. We are evaluating whether or not we're going to make a big sector push. Many of you that own the tactical allocation portfolio that we manage will note that we did finally relieve ourselves of the energy MLPX position here recently in an effort to take profit. And we are actively evaluating where we can find other opportunity. And for now, we're totally satisfied putting that money and using the money market, which largely speaking, money markets are paying about 4.5% right now this year. To keep the money available and liquid is a really nice alternative while we patiently try to wait to see where there's going to be even greater opportunity for 2023 and beyond. Bhavna, is there more that you wanted to touch on with this with regard to sector, or are we good to keep it moving?
No, I think you did a pretty good job at summarizing everything. So we can move on to talk a little bit about bonds, because again, it's been quite a year for bonds. And again, I think the headline for this slide kind of sums it up pretty accurately. It was a disaster of a year for bonds. Across the board, whether you were, especially, if you were invested in longer duration, longer maturity bonds. And again, in hindsight, it makes obvious sense. The bond market is essentially coming off of almost a 40+ year bull run market. And we were starting last year with 0% interest rates still being a reality. And again, when the interest rates are that low and the yields are that low, bonds lose the protection that they generally offer. And in generally speaking, traditionally, there is obviously also a lot that's always said about how the equities and bond are negatively correlated, and that's the genesis of creating let's say a 60-40 allocation, which is considered to be more traditional, more moderate in risk, because the idea is that if the equity aspect of your portfolio is suffering, bonds would come to your rescue and will provide you the stability you need. But again, last year was yet another exception to that general thinking. And again, that correlation kind of broke down. And bonds and equities both did pretty bad last year, leading to, you'd mentioned this earlier in the conversation, it was one of the worst performance year for a 60-40 portfolio since 2009. So again, pretty dramatic. For us at IOC, we were pretty focused on being very mindful of the fixed income and bond allocations that we were adding to our client portfolios, in 2021 and early 2022 and all through last year for that matter. And we were, again, focusing on higher quality, very short duration, because that was the only relatively safe place to be in an environment like last year. And again, numbers kind of speak for themselves as to why the losses are much bigger for longer duration versus shorter duration.
Short term -7, which is hard to swallow, but certainly better than 15 to 32%.
Exactly.
Here's your historical context right here.
Again, I talked about it just a little bit. Look at the chart on the left, and you can see that we are breaking away from a 40-year trend, that trend line very clearly. And that's pretty interesting. That does, again, put things into perspective. And I really like the chart on the right as well. I know it's a little busy chart. There's a lot going on, but essentially what this chart is trying to tell us, every gray line that we see is essentially, a look back into the last 35 years for the bond market. So every gray line is representing a year in terms of how it did. And then we can clearly see 2021 and 22 kind of sitting out there on the negative end of this curve. And you'd mentioned this earlier in the conversation as well. Just the negative performance in the bond market last 2 years ended up, just completely erasing performances from the total returns that clients had over a 5-year period, which is pretty dramatic for a bond market. You don't necessarily expect to see those kind of activities. But there is a lot to be talked about on that topic, because to some extent, this kind of an environment, had also created a little bit of an enabling effect wherein, it was easier for the Fed to actually start providing more liquidity to the markets, actually directly contributing to the deficit and the debt levels that we've accumulated over the years as an economy. And we'll talk about that a little bit going forward as well, as to how, breaking away from this 40-year trend line is, again, going to add more complications to what the Fed really is trying to address right now. And another angle that they need to think through about saying, now that the interest rates and therefore the yields being much higher than what we were getting used to over the years, what does that mean for a lot of other things that unfold, as there is, again, a lot of ripple effects coming out from just one decision of where the interest rates right now are. Again, this slide kind of talks about that a little more from that perspective, saying, through those 40 years, we've also accumulated a lot of debt because it was easier to provide that additional liquidity to the system without much implications in terms of the interest that you were accruing on all those new treasuries that were hitting the market. Our debt levels, federal debt levels are 120% of GDP. And for a minute there, during when we were fighting off the pandemic and again the overstimulation of the economy, we actually got to 140% levels for a minute, because again, temporarily there was a lot of justification for why it's needed. But if you put that into, again, zoom out a little bit and look at where we were, pre-financial crisis period, we're far off from those historical levels, and we've accumulated so much debt over a period of time. And the only other comment I want to make on this slide is and how it relates to everything else that's going on is that this is another reason why the Fed just can't keep increasing interest rates for trying to control inflation on the other hand, because now with the debt levels so high and the Fed's own balance sheet kind of ballooning into such a big number, every interest, every quarter, 1% interest rate hike leads to very meaningful numbers in terms of the, how it adds to the net interest payments for the government and directly adds to the fiscal deficit levels. I mean, again, just to kind of throw some numbers around that, and we talked about, again, just to kind of put into perspective in terms of what interest liabilities can do to the fiscal deficit level. We just for the first 2 months of the fiscal year 2023 for the US government, which is essentially October and November, it paid out $103 billion in just, interest payments just for those 2 months, which on a year-on-year basis is 87% higher. So again, kind of gives you a pause and actually makes you realize that there are so many indirect implications of trying to control inflation by increasing interest rates and what that does to the Fed's own balance sheet and to the government's overall debt levels.
Yeah, I mean, it's interesting, Bhavna, when we think about what the government spends money on, most people tend to think, Medicare, Social Security, those kind of things. And entering into this conversation, given the current debt load, as you've explained beautifully, in the relatively high interest rate environment, certainly where we've been, that combination of things. Now, the amount of money that we're spending on just the interest alone on our treasuries is becoming one of the largest expense items that the budget has to deal with and contend with. And it's going to be interesting to see how that shapes up, because that is going to end up, I think, dictating, as we start to reconcile the huge amount of debt and the high interest rate, exactly what that impact is going to be on the US economy, because it's going to potentially have a huge impact to government spending, which has we keep saying this, but ripple effects across everything.
Right.
Real estate market, I'm going to skid through this in the interest of time, but because everyone always asks, so what's going on with the price of my home? And I get that, and we understand it. Home sales are way down. Look at it's a sequential move since the financial crisis, since the housing crisis, better said. Home sales haven't been what they were. And I'm talking about the velocity of homes hitting the market, selling, moving, and changing. So that's been dramatically changed. We're seeing that in home supply and in home sales. So the amount of homes on the market is so few, and they're not turning. So when you're looking at that, we're seeing that is very supportive when you have very few homes on the market and they're not turning very quickly. That in combination is doing something to hold on to home prices to where they had been. And we're seeing year over year, even though home prices have come down some, they're still on a year over year basis have increased. One of the things that homes have had to deal with and home prices have had to reconcile with is the mortgage situation. And we saw the 30-year mortgage, which I have so many clients that their 30-year mortgage is under 3%, a historically low number. It's amazing. So congrats for those of you that owned a home and were able to refinance or buy a home with that kind of interest rate, because those that were trying to do it a couple of months ago were looking at a 7% number, which just dramatically changes the home affordability. It changes your payments depending upon the size of your mortgage by hundreds, if not thousands of dollars per month. So we saw this meaningful and dramatic change to mortgage rates. We've seen that did have a pretty immediate impact on housing prices. And we have seen the 30-year mortgage step back a little bit. I do put the yellow 30-year mortgage and I put the 10-year treasury right along with it, because there is a lot of similarity with how those both of these things move together. Obviously, it looks like a perfect dance where one goes up and one goes down. We're keeping our eye on the 10-year treasury. We're keeping our eye on mortgages, because this is going to continue to have a strong impact on home prices. Okay, so broadly speaking, home prices, you're still good year over year. Yes, we have seen a change. If we see persistently high 30-year mortgage rates, look for continued trouble with the real estate market, and pay attention to the amount of homes that are sitting available on the market, because at some point, should that reverse itself to more normalized levels of the number of homes that are available for sale, that could also have a material negative downward move to the price of your residential real estate, which is also concerning for consumption, because consumers, when they feel like their houses are worth more, they tend to spend more. So we're watching it. Right now, it's an asset on the consumer's balance sheet, but we're looking to see if it does slip into something that looks a little bit more negative throughout the course of the year. In talking about what we're watching throughout the course of the year, we need to talk about the Fed pivoting. First of all, Bob, now what is a Fed pivot? And is it going to happen? And is the market going to celebrate if the Fed changes its mind?
That is the biggest question on everyone's mind for this year, for sure. And again, let's talk about it. What is a Fed pivot and why is it such an important question? Essentially, a pivot is when the Fed, kind of reverses its policy outlook, or kind of trying to change the course, going from, loose monetary policy to a more tighter policy. And that obviously has a lot of implications on its own. And we're kind of transitioning through that phase wherein, not that long ago, early last year, we were sitting at 0% interest rates to now wherein we've seen back-to-back significant interest rate hikes to try and tighten the economy so that it can bring inflation under control, so that we can be back on track again. Why does it matter? Because when the Fed goes from its current tightening process and wanting to increase interest rates to saying, oh, we can go back to loosening again, that would be a victory sign saying we do have things under control. Inflation is under control, everything is fine. So that's why this is an important question. When the Fed pivots would be, an indication of things being under control and everything is good to go, is why everyone is paying attention to it.
What does the data say, Fed pivot?
And there are some interesting things to be talked about in that. I'm going to skip through this slide because we talked about how, the Fed has created such a big Fed balance sheet for itself, and it's complicating matters for them. But what it really comes to, what the Fed thinks right now versus what the market is expecting to happen. And there is a little bit of a disconnect between that. So if you see that black dotted line on this chart, which is essentially saying that based on where the Fed is and its assumption that inflation is a little more stickier, we'll take longer to declare victory on everything. That rate currently based on the projections sit at around 5.25%, and kind of stays there through. So their thinking is that we'll get to that level probably towards the middle of this year and just sit tight and see how that unfolds through and whether it creates the desired effect or not. Versus from a market's perspective, it isn't really buying into that mindset just yet. What the market is indicating is that we'll probably peak out on those Fed rates again towards the middle of the year at around 4.97. But we'll also see that pivot happening this year, and kind of the Fed starting to decrease interest rates again before we end the year. We think that's a little premature. The Fed is making sure that it makes it clear to the market that that's not where they stand right now. We do think it makes sense for the Fed to get to a certain level and pause and stay there for a little bit and think of a pivot possibly in 2024. But again, that is the biggest question on everyone's mind because it will have so many other effects on everything that we've talked about today.
Yeah, it just seems to me, Bhavna, that we're in this environment where we did this. We're in this economic environment where the good news is no longer good news because the Fed's going to end up acting differently than what the market wants to see, and it's almost like bad economic news is good news because then the Fed will work with us. I don't know. It's interesting the way that the market works, and it's interesting that how it all comes together, which brings us to key themes for the year. We try to summarize it on one page. So the key themes to look out for the year look a little bit something like this. We do, and as we've talked through a lot of this stuff, but we wanted to sum it all together. This tight monetary policy where the Fed is both shrinking the balance sheet and increasing interest rates, as we've talked about at the same time, is super restrictive. It is going to do something to restrict growth. How much growth is it going to restrict is really difficult to ascertain because, as we've mentioned, the consumer is still pretty strong and there's a lot of great areas of the market to support our economic output, yet at the same time, the Fed's trying to put the brakes on. It is a very delicate operation because we see the consumers are spending themselves into a wall. So our stance is, we are going to continue to be patient. If we look across Schwab, let's just say, so we look across Schwab as an institution and their $6 trillion or so assets. Numbers suggest that people are sitting on about 12% cash. That seems like an astounding number. So we see not just at Schwab, but across the broad spectrum of investors and institutions across the country, a lot of money sitting on the sidelines and waiting. We're no different. We are patient and we are waiting for some kind of price improvement. Hopefully we see, Bhavna did a great job talking a little bit about corporate earnings. Maybe there's a little bit of realization that earnings aren't going to be quite as good as forecasted. Maybe we see a little move down there. Maybe the market comes to the realization that the Fed's going to be higher for longer, and the market realizes there's a little bit of disappointment there. But we do believe that much of the real negative, draconian, recessionary fears have been brought forth and put into the market pricing. I mean, the tech growth part of the market was down 32% last year. That's a huge realization of what's going on. We've been fairly neutral on international. We can see a course where you might see more international in your portfolio than you're used to seeing. So look for us to take some action, and we're certainly doing a tremendous amount of research there. We're going to continue to stay short, stay low, and stay high quality with our bonds, especially because we're able to earn such a great rate of return now. A 10-year treasury paying 3.5% is not as exciting as a money market paying 4.5% for me. We're just not quite there yet to go longer term with some of our fixed income bond opportunities. And the same thing with things like, CDs, which we could buy at Schwab, are not things that we would consider. We are cautiously looking at high yield bonds. Is there an opportunity for us to be buying things that are higher yielding, a little bit on the lower on the credit scale? We are paying attention to opportunities in real estate. There are some folks where we found real estate portfolios that are actively buying into this real estate market right now, which is featuring a lot of real estate properties that are for sale, are usually sold by those that need to sell, which creates pricing discounting. So we're excited about that. And we are, again, some volatility is going to create some opportunity for us. So look for us to be nimble, thoughtful, and patient with this market. This is exactly where we are. This is not the kind of market and not the kind of economic climate where we're buying stocks with both hands. I think we've made that pretty clear over the past hour and laid out a lot of the different data sets to help bolster that. But so expect some continued volatility of the market. We'll be there to hopefully capitalize on it. So, well, that's what we're expecting now, Bob. But what about the next 10 years?
Hang on to, the words that you just used, staying nimble, have patience, be cognizant of the risk that you're taking. And that's really what the next 10-year forecasts are also telling us based on a few different ways in which we look at it. For example, if you go to the next slide, this is an in-house model that we use, again, almost as a sanity check for ourselves, saying, if we were to just make some very, very baseline assumptions about the GDP growth, converting that into what we would expect in terms of corporate earning growth over the next 7 years, what do we see? And again, just to kind of give it a very quick takeaway, if you see more green on the screen, that's encouraging. If you see more yellows and reds, that's just basically a signal for us based on that very basic data points that the next 7 to 10 years in the market for the equities may not be as promising.
I see more greens.
Yeah. So again, and we've talked about this a little bit earlier in the conversation, saying everything that we saw unfolding last year has been a good advance on saying that, okay, a lot of that was in anticipation of this year. So that has improved our 10-year forecast on the market. And if we skip to the next 3 slides, I'm going to just sum them up together, which again goes back to the points I was making earlier. It's been a full 3 year, almost a full circle. We started with 2020 with better prospects on the 10-year returns because of the 40% decline that the market had seen earlier that year. For example, the US large cap was sitting at around 4% average return levels. Cut to 2021, which was just way ahead of itself on so many different things, including the expansion of pricing that we saw in the market, which made a serious dent to our 10-year forecast projections at the end of 2021. It came, for example, again, for US large cap, it came down to almost 1.5%, because again, so much of that was packed into what had happened in 2021. Cut to end of 2022. Now, thanks to what a terrible year 2022 has been, kind of back to those 2020 levels on our 10-year projections. So again, US large cap kind of inching back into that 4.5% levels in terms of projections. So again, a very long-winded way, I think, throughout this presentation to say, actually, the last 3 years have actually did and undid a lot of things for us. And there we are.
I went through those disclosures really quick. So if for anybody that wants the slides, you send me an email, I send them out, no problem. Bob, no, this was fun. This is fun. I mean, that was the fastest hour.
I'm looking at the clock and I'm like, oh my God, where did the hour go? We're above the time, and it feels like 5 minutes to me.
I know. Well, normally people say that hanging out with me feels like hours, even though it's only been minutes. This was the exact opposite. So thank you for making it fun. Thank you for tuning in. So, this will be recorded over the next couple of days. We put a little front and back on it and then beautify it up and then send it out the door. I think oh geez, a couple more questions come rolling in. How do I see those questions? Oh, okay. All right. Oh, did we not say, recession, yes or no? Let's do that, recession, yes or no. Look, I know what you're looking for. You're looking for a definitive. So right now the market's expecting a recession, yes. The stock market was reflecting a recession, yes, which is part of the reason why we just discussed in 2022 why the market went down. So right now it does not seem and feel as inevitable as the consensus is. And so here's the thing we're typically at. We do try to be contrarian thinkers, and what that means is, if everyone thinks the same thing, then that's usually what's not is going to happen. And there's just this huge growing tidal wave consensus that there's definitely going to be a recession. So, given all of the data points that we've discussed and given what we're looking at right now, it doesn't appear inevitable that if we do end up getting recession, it's going to be one that requires us to take cover and hide. This does not feel like it's that way. So a recession, in terms of whether or not it's something we need to absolutely completely sell all the stocks in your portfolio and wait, that does not seem to be the kind of economic circumstance that we're looking at. And I point to, amongst many other things, the strength of the consumer and the job market right now that's holding up the market and the economy very, very well. Bhavna, what would you like to add on recession, yes or no?
I think I want to take a slightly different take on answering this question in a way that I would want to normalize recessions. And can I emphasize on that?
Great point.
It is a very integral part of business cycles. So this is definitely a most talked word it's almost the word of the year last year. This is not going to be the first recession that we've seen in the history, and if it is, it will not be the last either. So again, I just want to take a few seconds just normalizing it. It is a very well entrenched part of a business cycle, and in a lot of ways it does bring out a lot of benefits too, is what I would say on that topic.
Right. Well, yes, great, perfect, wonderful. I didn't say yes, by the way, to recession, but so again, we hope you enjoyed this. We look forward to your feedback, your thoughts. Again, you want the slides, let us know. We'll send them out. Yeah, so that's it. We're good for today. So if there's other questions, we'll go ahead and answer those offline. Thanks again for tuning in. Take care, and we'll talk to you next quarter. Bye-bye.
Thanks, Michael. Bye, everyone.
See ya.